Ladies and gentlemen, that violent red candle on your screens wasn't just a standard pullback. Silver spot kissed 83 fiat dollars, then while the stackers slept, the paper price collapsed into the low 70s in mere minutes. A 14% tamp down doesn't just damage fiat portfolios. It crushes stacker confidence and pushes rational folks toward the most dangerous move in the game, panic selling under maximum pressure. Listen closely because this is vital. This move wasn't driven by true market fundamentals. It wasn't a sudden collapse in industrial demand, a mining supply shock, or retail stackers taking profits. The timing alone exposes the rig. The drop hit during the thinnest liquidity of the year, that ghost week between Christmas and New Year, right around 2 a.m. Eastern Time. Who was actively trading paper silver at that hour? Not everyday stackers, not long-term holders, and certainly not pension managers on holiday. At that moment, the order book is a hollow hallway, and in a hollow hallway, even a small shove echoes like an earthquake. What likely happened is both simple and brutal. A heavily leveraged institutional player breached maintenance margin limits. In the institutional world, there are no warnings and no second chances. Controls handed to a risk engine, a cold algorithm with a single instruction: get out. It doesn't care about support levels, indicators, news headlines, or emotion. It dumps paper contracts until the account is solvent again, completely price agnostic and relentless. In a healthy market, buyers absorb that flow. In a holiday vacuum, there are no buyers. The algo sells spot drops, liquidity disappears, and the cascade feeds on itself. That is why the chart looks like a sheer cliff. The first lesson is this: before you react, ask whether a move is informational or mechanical. One changes value, reality; the other only exposes leverage. And if you panic sold, in that moment, the market didn't move you, it read you. Now that we know this was mechanical, the real question is why the tamp was so extreme. Why didn't silver stop after 1 or 2 fiat dollars? Why did it slice straight through levels traders believed would hold? The answer lies in liquidity, or more precisely, in what happens when liquidity vanishes at the worst possible moment. During normal market hours, prices feel stable because a thick wall of buy orders sits below the market. That bid stack absorbs selling pressure. But during Ghost Week, especially in the middle of the night, that wall is barely there. The market looks open, but structurally it is hollow. There are spot prices on the screen, yet very few real buyers committed underneath. When the forced liquidation began, the algorithm dumped into that emptiness. The first wave pushed price down, searching for buyers. It found almost none. So it dropped the price again, not because value changed, but because the system was hunting for liquidity. Each dollar lower was an attempt to find anyone willing to take the other side of the trade. This is a liquidity cascade, and once it starts, it doesn't respond to logic headlines or sentiment. It stops only when physical buyers finally appear. This is where most new investors misread crashes. They assume red candles mean voluntary selling. In reality, much of this move came from sellers with no choice at all. They were not making decisions, they were being liquidated. That distinction is critical because it tells you whether demand truly vanished or simply stepped aside. By the time spot reached the low 70s, the forced seller was nearly exhausted. The pressure eased, not because fear disappeared, but because the weak hand was gone. And that leads to an uncomfortable truth. These events feel catastrophic, but they also cleanse the market. Leverage is flushed out, excess risk is removed, and what remains is a structure held by true diamond hands. But this liquidation was only the first domino to fall. What followed turned a bad move into a historic one. Just when it looked like the damage was done, the market crossed a line most investors never see. This is the point where a forced liquidation turns into a self-reinforcing collapse driven not by fear but by cold mathematics. To understand why the drop accelerated so violently, we need to talk about one word that quietly controls modern markets: gamma. Large bullion banks and market makers constantly hedge option exposure. Under normal conditions, that hedging stabilizes price. But when volatility spikes and price falls too fast, those same hedges can flip from stabilizing to destructive. This is what traders call a gamma flip. It happens when dealers move from positive gamma to negative gamma, and when that happens, the rules of the game reverse. In negative gamma, every dollar decline forces dealers to sell more of the underlying asset to remain hedged. The market drops, the hedge demands more selling, and that selling pushes the market even lower. It creates a feedback loop that feeds on itself. No one is panicking. No one is making emotional decisions. The system is simply obeying math equations. As silver broke through key levels, this gamma flip activated across the options market. Banks that were previously neutral suddenly became forced sellers alongside the liquidating institution. Instead of absorbing the fall, they amplified it. Spot drop dealers sold to hedge price dropped further, and the loop tightened. This is why the move went from sharp to violent in mere seconds. This phase is what turns a chart into a vertical line. From the outside, it looks like mass capitulation. Inside the system, it is pure automation. Risk models don't debate. They execute. And during Ghost Week, with almost no opposing flow, that cold execution had nothing to slow it down. What matters most is this gamma-driven selling is temporary by nature. It ends when volatility stabilizes and positions reset. Once the options books are rebalanced and the forced hedging stops, the pressure vanishes as quickly as it appeared. No long-term seller remains truly behind it. So when you see a move like this, you are not watching true value disappear. You are watching risk controls collide in an illiquid environment. And once that collision burns itself out, the market is left asking a very different question. Why did it stop exactly where it did? That question matters more than anything else. If this was a true liquidity cascade, if forced liquidation and negative gamma were feeding on each other in an empty market, why didn't silver keep falling? Why did it stop precisely in the low 73 range and not continue to 60 or lower? In a pure vacuum, prices do not gently stabilize. They collapse until something just intervenes. The answer isn't sentiment, and it is not retail stacking the dip in real time. At that hour, the system itself began to feel stress. Forced liquidation does not exist in isolation. Every contract has a counterparty. Every loss shows up somewhere else on the balance sheet. And eventually, those losses concentrate in one place, the clearing infrastructure that guarantees the trades. As the liquidation intensified, the risk shifted from a single failed account to the integrity of the system that stands behind every futures transaction. When a large participant cannot meet obligations fast enough, the problem stops being about price and starts being about solvency. This is the moment when markets stop functioning as discovery mechanisms and start behaving like active fault lines. At that point, bids didn't appear because traders suddenly felt optimistic. They appeared because the plumbing of the financial system could not tolerate further strain. Liquidity, which had vanished minutes earlier, re-emerged abruptly. That kind of response doesn't come from speculation. It comes from pure stabilization. This is why the low matters. It was not a technical level chosen by traders drawing lines on charts. It was a boundary defined by risk tolerance inside the system itself. Below that level, losses would have spread too far too fast. So the cascade was finally contained. Understanding this reframes the entire event. The market did not find fair value at 73. It found the point where disorder became unacceptable. And once that line was drawn, the character of the market changed again, shifting from collapse to active containment. What happened next tells us who was really in control during those final moments of the drop and why this event was never just about physical silver. To understand who drew that line, you have to follow the stress signals, not the price chart. When silver slammed into the low 70s, the real alarm was not flashing on trading screens. It was flashing deep inside the overnight funding markets. This is where price volatility stops being a simple trading problem and becomes a systemic one. As the forced selling accelerated counterparty risk exploded, banks began to question whether the institutions on the other side of these trades could actually pay. When that doubt appears, lending freezes. Dealers pull bids, credit lines tighten, and the machinery that keeps markets liquid starts to seize. This is how localized damage threatens to spread into something simply much larger. At that moment, stability mattered more than profit. Liquidity did not return because someone believed silver was cheap. It returned because the system could not afford another hour of uncontrolled stress. Cash was injected, balance sheets were reinforced, and confidence was quietly restored behind the scenes. No announcements, no headlines, just pure action. This is a critical distinction most investors miss. The system did not intervene to save silver. It intervened to save itself. Silver was simply the pressure point where the weakness surfaced. Once liquidity reappeared, market makers were willing to quote prices again. The cascade lost fuel, and the fall finally stopped. That rebound felt completely fake. 1 second liquidity vanished, the next the buy wall was massive. This shift proves the smash was never organic. It was a paper market malfunction that demanded a systemic intervention to prevent a total lockup now. Once the rig stabilized, a huge truth emerged. While Western paper derivatives cracked under leverage, the physical market flashed a totally opposing signal, a real signal that flat-out refused to validate the fake spot price crash on the screens. While the Western paper casino convulsed from forced margin calls and emergency stabilization, the physical side barely even flinched. This divergence is not a footnote. It is the ultimate confirmation signal. When price truly collapses, it drops everywhere. That is simply not what went down right here at all. As New York battled margin calls and blown risk models, the Asian stackers told a different tale. In Shanghai, silver traded like the overnight tamp never happened. Premiums stayed high solid and decoupled from the paper smash. This isn't luck. It is market structure. The Eastern market runs on physical stacking, not leveraged paper shorts. Factories and state entities are not gambling on charts. They are draining the vaults. When they see spot drop due to Western glitches, they don't fold. They check physical supply. In this specific case, the metal was still tight. That split in action exposed a massive canyon between two realities. On one side, a paper fraud ruled by leverage and algos. On the other, a physical market ruled by actual possession. The spread that blew out between them wasn't static. It was a clear diagnosis of a broken pricing mechanism. A massive premium in the East while the West dumps signals manipulation, not balance. It proves the selling was local fake and fleeting. True physical stackers were not validating the paper crash. They were totally ignoring the price noise. This is how you spot real money versus the show. When the metal holds value elsewhere, demand isn't the issue. It is the rigged pricing tool. Paper mechanisms can fail hard without changing the physical reality one bit. That truth flips the script. The smash wasn't a verdict on silver's value. It was a stress test of the broken Western casino. Once you see that, the big question hits. If physical demand held the line, who was dumping paper and who was stacking quietly during the panic now? Once you ignore the mainstream news and track the vaults, the answer hurts the official story. The dump didn't come from apes losing faith. It came from banks that had zero choice. Meanwhile, the buying came from silver whales who knew exactly what this setup represented truly. During the big tamp, retail stackers did the opposite of what the TV talking heads claimed. Instead of selling, the diamond hands backed up the truck. Volume spiked on accumulation, not capitulation. Retail panic is loud on the charts, but it leaves traces. Those traces were totally missing from the data now. The only aggressive dumpers were the big banks and their algos. Huge paper blocks hit the COMEX in seconds, a signature of machines, not human fear. It was forced liquidation. Once those blocks cleared, the selling pressure vanished instantly. That is not how a real bear market moves. Real bears grind prices down. They don't crash in minutes at all. At the same time, physical ounces were quietly draining from the vaults. Metal was withdrawn, not deposited. That action destroys every claim of weak demand. If silver was trash, it would flow back to the refiners. Instead, it was vanishing. That is stacking, not selling. Here is where the illusion breaks. Paper spot fell because margin blew up. Physical stacks grew because real value never dropped. These two things happen together, and when they do, they create the deal of a lifetime for apes who look past the rigged screens. By the end of the flush, the weak hands were shaken out. The forced dumpers were done. What remained were stackers who didn't care about margin calls or liquidity. That shift matters because the price moves very differently once the selling becomes voluntary again. Now, with the tamp behind us, the calendar itself becomes the catalyst. The low-volume week is ending, and when the real traders return, rigged prices rarely stay rigged for long periods. The timing of this raid isn't random, and neither is the pump. The holiday thinness created the void that let this flash crash happen, but that same void delayed the buyback from the big desks. Spot doesn't reset until the volume returns, and that liquidity is coming back right now, folks. When the traders get back to their desks, they won't feel the fear. They will see the arbitrage. They see silver smashed down on low volume while physical premiums held strong globally. To a smart money manager, that chart isn't a warning. It is a screaming buy signal for hard assets that they simply must grab right now today, surely. Fake prices from forced dumps snap back fast once liquidity returns. Why? The sellers are out. The margin calls are done. The option books are reset. What's left is a spot price that screams cheap silver. And when cheap silver appears in size, big capital always responds to it now. This is why the moonshot surprises the herd, not because it's magic, but because they don't get it. The same volatility that crashed the price works in reverse when the tamp ends. When buyers return, the bids don't trickle in. They snap back violently. This is why waiting for the official all clear means missing the boat entirely. By the time the chart looks safe, silver has already ripped. The market rewards stackers who identify the structure before the herd wakes up now. The goal now isn't guessing the exact price, but seeing that the crash conditions are gone. The shorts are spent. With the new year starting and volume returning, the focus moves from surviving the smash to positioning for the launch upwards effectively. That brings us to the final check for every silver stacker. What did this tamp teach you, and how do you stack when the rigged system shows its cracks so openly to all of us today, huh? Events like this are rare gifts. They strip the casino down to the gears and show who has the metal. The biggest error is treating this as noise instead of intel. This wasn't random volatility. It was a diagnostic of the paper scam, plain and simple, for us to see here. The first lesson is structural. Leverage equals fragility. When the market is calm, margin looks smart. When the tamp comes, it becomes a trap that forces you to sell. If you were not forced to sell during this event, you are already way ahead of the paper traders who got washed out entirely, friends. The second lesson is mental. The spot price lies to you. A red candle triggers fear because you think it's real selling. But as we saw, this was just algos triggering algos. Knowing that the price is fake is the key to holding your stack when the rest of the world is panic, selling their paper contracts completely. Lesson 3 is global. The COMEX is not the world. When the paper price crashes but Shanghai holds, the truth is in the spread. Physical demand vault movements and premiums speak the real truth much louder than the painted charts on your screen. Finally, learn patience. These paper scams fix themselves on their own time, not yours. The market doesn't pay the fastest ape. It pays the smartest one. That means knowing if the risk actually spiked or if the bag was just handed from weak hands to strong ones now. This crash transferred the risk. It moved silver from leveraged gamblers to diamond hand stackers. That isn't bearish. It is the foundation. Markets held by apes behave very differently in the weeks that follow a major flush. So the final chapter isn't fear. It is strategy. How to stack, how to hold, and how to use these tamps not as threats but as massive buying opportunities for all of us, really. What happened overnight wasn't a warning to run. It was a masterclass in how the rigged game works, and an opportunity disguised as chaos. Connect the dots. A leveraged player failed, risk engines executed blindly, liquidity vanished, the system intervened to save the casino from collapsing entirely, thankfully indeed. And through all of the noise, the shiny never lost an ounce of value ever. The strategy is simple. Don't mistake a forced liquidation for the weak fundamentals. When mechanics drive the price down, it creates a distortion. That distortion is where the gains are. The winners aren't the high-frequency traders. They are the stackers who know the structure and stay liquid while the banks burn hard forever. This tamp proves why you hold physical. Metal in your hand behaves differently than a contract on a screen. Volatility doesn't destroy ounces, it just moves them. In this case, the silver moved from weak leverage balance sheets to the unbreakable vaults of the true apes effectively. Next time the spot price gets smashed, remember this moment when fear spikes. Ask if it is paper hands folding or whales stacking physical. Check if premiums reflect true value or paper noise. Real ounces count more than rigged charts. Above all, keep stacking the dip. Dips like this are where your ounce count grows faster than fiat savings. If this helped you spot the manipulation, ensure your stack is ready for the next big tamp down. If you value sound money talk, type 1 below if you are never selling your physical stash, or 2 if you see the paper rigging now. Subscribe for more hard asset truth. Share this with fellow stackers who need to wake up and stay frosty. The rigged market crushes panic sellers but pays the patient silver stackers very well.